Ticker symbol WBA or Walgreens stock is now on a massive flash sale, down over 40% year to date after the CEO recently resigned last week. With Walgreens stock now offering a starting dividend yield of over 8%, 47 years of dividend growth, and 91 years of uninterrupted dividends being paid. Dividend growth investors like myself are curious on whether or not Walgreens could be a buying opportunity at these levels. Well, in this video, we are going to do a deep dive into WBA and go over all the good, the bad, and the ugly, and come up with a conclusion on whether or not the stock is a buy from here, or of course, if it's just another toxic yield trap to stay far away from. Now stick around because we have a lot to go through. Right after you, please drop a like on this video and subscribe for more future content like this. So like we mentioned a second ago, the Walgreens CEO did abruptly decide to step down after just a few years within the role. This article says Walgreens' Rosalind Brewer has stepped down, the U.S. pharmacy chain operator said on Friday. And this is less than 3 years after the former Starbucks executive took the top job. Now, Brewer's departure was apparently a part of a mutually agreed upon decision, Walgreens said, without providing any further details from there. And since the CEO's departure, Walgreens stock has seen even lower lows, now trading just about at the 52-week range low at just $22 per share. The 52-week range is massive at $21.92 as of the low and $42.29 as of the high, making Walgreens down almost 41% year to date. But to be fair, if we look at Walgreens on the max time frame, and of course this is not even dividends included, but Walgreens has performed pretty good since inception, up around 350% plus as far as all time, just going off a price return of course. But ever since about 2015 or so, Walgreens stock has continuously traded down with just a few glimmers of hope between then and now. And believe it or not, around 10 years ago, Walgreens was actually almost a $100 per share stock. Now, part of the recent pessimism in Walgreens stock is that the net income has been negative in the trailing 12-month period at minus $3.3 billion or a minus $3.84 EPS. Now, these poor results are mainly due to the $6.5 billion pre-tax charge recognized in the connection with the opioid litigation settlement frameworks and certain other opioid-related things. Now, even with all the struggles Walgreens has seen as of recently, Walgreens still has a strong business portfolio, and efficient operations has allowed it to achieve an average return on equity, or ROE, and return on invested capital, ROIC, of around 11.9% and around 9% respectively, and this is over the last decade or so. Now, looking a little bit into Walgreens' cash flow, strong businesses with wide moats like Walgreens are able to generate cash flow beyond what is needed to fund sustainable operations. And as seen down below, capital expenditures and acquisitions have averaged only 45% of cash flow from operations, or CFO, over the past decade. Now, looking a little bit into Walgreens' financials, if you look at Walgreens' revenue since around 2018, one thing's for certain, the company has not really grown all that much at all. And although it's been able to pretty much maintain its revenue over the last few years, the sort of stagnant revenue and lack of growth definitely worries me as an investor. Another thing to keep in mind, especially for dividend growth investors, is the fact that Walgreens' earnings payout ratio has been creeping up over the last few years. And also as of recently, the free cash flow margin has sunk below 0%. Also important to note, the total sales for Walgreens has pretty much been stagnant for the most part over the past few years, with the last 12 months being a little bit higher than the previous. But with Walgreens stock getting absolutely demolished as of recently, it's offering an 8.71% forward dividend yield, which if we look at Walgreens' dividend yield historically, this is one of the highest dividend yields that's offered investors that could possibly lock in a once-in-a-decade opportunity to buy a company like Walgreens with an almost 9% starting yield. And even though Walgreens does have a history of raising dividends and paying dividends on time for many, many years now, some investors are definitely still concerned about a possible dividend cut coming soon. Now, in addition to the recent CEO stepping down, Walgreens as of now has no permanent replacement named. And Walgreens said it now expects a full year 2023 adjusted EPS to be at or near the low end of its previously stated range. Now, looking a little bit deeper into the safety or lack of safety when it comes to Walgreens' dividend, which is important especially for dividend growth investors that are hoping to lock in a massive dividend yield by buying into this more risky stock as of now. Simply Safe Dividends just recently downgraded Walgreens from a 70 safe score to a 50 borderline score. And this is of course due to things like the CEO stepping down. Also, Simply Safe Dividends said that the dividend could be in jeopardy, and because of Walgreens' balance sheet, which S&P assigns at BBB credit rating with a negative outlook, doesn't have a great capacity to take on more debt without risking its investment grade status. A smaller dividend payout would make more cash available for investments or deleveraging, paying down debt, etc. They also said the bottom line for Walgreens, sudden leadership changes in the middle of an expensive strategic push creates a lot of uncertainty about the firm's future capital allocation priorities, especially as rivals pull further ahead in their own vertical integration efforts to make healthcare sector more efficient. They also said that if we were shareholders, Walgreens' sudden leadership changes and impending strategic shift would likely be the deciding factor that prompts us to cut our losses and sell our shares. While a company's core retail pharmacy business still looks like a durable cash cow with modest growth potential, Walgreens could be facing years of work to get to the business mix that it needs to really push forward and grow. So is Walgreens stock, ticker symbol WBA, that's down almost 60% over the last 10 years? In my opinion, a buying opportunity. Well, throughout my portfolios, I think I currently own maybe 50, 60, or 70 shares of Walgreens altogether that I've been holding on to since around 2020. Now, I'm currently down quite a bit on my shares, and I personally would not be adding any more shares of Walgreens from here unless there's some sort of bullish catalyst that seems like it's going to catapult Walgreens to the opposite direction. But looking at Walgreens' price performance on multiple different time frames, and just understanding exactly how the business works and the sort of lack of potential growth options that the business might have from here, it feels like to me, even with the stock offering an 8.71% starting dividend yield, there's still other options throughout the market that has more of a long-term business model that I want to be attached to, and also a much safer dividend moving forward. Because I personally would not be surprised if Walgreens does cut their dividend sometime soon here to do like we said earlier, conserve cash, and to maybe even pay down debt and deleverage during this whole CEO fiasco. Now, a lot of investors at this point would consider Walgreens nothing other than a shiny yield trap. Now, what a yield trap basically is when a stock or ETF is offering a massive starting dividend yield, but to go along with the super high dividend yield, it comes with a massive price decay, for example. Like Walgreens over the last 10 years is down almost 60%. So even if Walgreens over the last 10 years has offered a 6%, a 7%, 8, 9, or 10% dividend yield, it doesn't really matter, because if you're going to invest in something and lose over 58% of your overall investment, if someone was to invest into that stock just because of the dividend yield, they basically got trapped because of the dividend. Now, that doesn't necessarily mean that every single high-yielding stock or ETF is going to be considered a dividend trap. Take something like Main Street Capital, for example. Main Street Capital is almost yielding 7% currently, and over the last 10 years, Main Street Capital is up over 53% just as far as share price. But when it comes to stocks like Walgreens, AT&T, Verizon, there's tons and tons to name off. There's a lot of single stocks that the dividend community sort of classifies as dividend traps that are really nothing more than shiny objects that attract dividend investors that, of course, have the dream of earning a ton in dividends on a monthly or a quarterly basis, but would be better off not buying it all because of the massive price decay. Just out of curiosity, comment down below if you think Walgreens is or isn't a dividend trap. But when it comes to ticker symbol WBA, are you currently holding on to any shares of Walgreens? And with Walgreens trading in the range that it's been trading in, are you personally buying from here? Comment down below. If you enjoyed this video, make sure to please drop a like in it and subscribe for more future content like this. Thanks as always for stopping by, and if you are interested in investing, make sure to check out these recent videos I posted right here.